Why passive income portfolios are superior to accumulating strategies? 95% of European investors are trapped in accumulating funds thinking they're being smart by deferring taxes and letting everything compound automatically. Meanwhile, they are missing out on the most powerful wealth building strategy known to mankind: passive income generation. I'm an ex-financial advisor who helped allocate over 10 million euros in assets across Europe before I went rogue and started building these insane income-generating machines. Now I share everything publicly on YouTube. No more one-on-one consultations, just pure, unfiltered income investing strategies. I've built a six-figure portfolio, which you can see right here, generating over $30,000 in pure passive income annually. That's a 25% yield hitting my account every single year. And today I'm going to show you exactly why my passive income portfolios absolutely crush accumulating strategies and how you can start building your own income generating machines right now. Welcome to Psycho Investor, where we don't just chase yields, we engineer income streams that would make your financial advisors lose sleep at night. I'm here to completely shatter the conventional wisdom about accumulating versus distributing investments. Everyone's being brainwashed into thinking that accumulating ETFs are the holy grail of investing. Just buy BWCE and forget about it for 30 years, they say. Tax efficiency, they scream. Automatic reinvestment, they preach. But what they don't tell you is that you are essentially building a prison for your money, locked away, generating no cash flow, completely dependent on market timing when you need income. Today we are diving deep into why passive income portfolios are not just better, they are essential for true financial freedom. I'll show you real numbers from my actual portfolio, break down the psychology behind why this works, and give you a complete framework for building your own income empire. Let me start by showing you something that's going to change how you think about investing forever. This is my actual portfolio, around $120,000, generating massive passive income streams. Look at the positions. Beta, 46% of my portfolio, pumping out 54% yield. JPQ, delivering consistent monthly distributions. Main, rock solid 4.17% yield with 21% capital appreciation. MSTY, 85% yield from covered call strategies, and TQQQ, triple leverage tech exposure with distributions. While accumulating fund investors are sitting there watching numbers on a screen, I'm getting paid every single month. Real money hitting my account. Money I can reinvest strategically, use for living expenses, or deploy into new opportunities. Here's what accumulating fund investors don't understand. Cash flow is king. When you receive actual distributions, you have options. You're not forced to sell shares at whatever price the market gives you. You're not dependent on perfect timing. You're getting paid regardless of market conditions. Think about it logically. Would you rather own a rental property that pays you rent every month, or one that just sits there hoping to appreciate? The same principle applies to your investment portfolio. But here's where it gets really psycho: the rebalancing advantage. When I receive my monthly distributions, I can strategically deploy that cash into whatever's undervalued in my portfolio. If beta runs up too much, I don't reinvest distributions there. I move them to underweight positions. This is organic rebalancing, happens automatically without triggering any additional transaction costs. Accumulating fund investors, they are stuck. Their money gets automatically reinvested into the same positions regardless of valuation. No flexibility, no strategic thinking, just blind automatic reinvestment. Now let's talk about something that will make every financial independence enthusiast lose their minds. Why passive income portfolios are essential for true FIRE, financial independence, retire early. The traditional FIRE movement tells you to accumulate assets until you hit 25x your annual expenses, then live off 4% withdrawals. But here is the fatal flaw. You're completely dependent on market timing and forced selling. Imagine you are ready to retire in 2022 when markets crashed. Your accumulating portfolio is down 30%, but you still need money to live. What do? You are forced to sell shares at terrible prices, permanently reducing your portfolio abilities to recover. Now look at my approach. My portfolio generates roughly 25% in annual distributions. Even if the market crashes and my portfolio value drops, those distributions keep coming. I'm not forced to sell anything. I can ride out the storm while still maintaining my lifestyle. This is what I call the passive income safety net. The more income your portfolio generates, the less dependent you become on market timing and forced selling. It's not just about financial independence, it's about financial invincibility. And let's talk about the psychological advantage. There is something incredibly powerful about receiving actual cash payments from your investments. It reinforces that your strategy is working, keeps you motivated during market downturns, and provides that tangible sense of progress that accumulating portfolios simply can't match. When markets are crashing and everyone is panicking about their portfolio values, I'm still collecting my monthly distributions. That psychological stability is worth more than any theoretical tax advantage. And here's something that accumulating fund investors completely miss: the incredible rebalancing advantage of passive income portfolios. When you receive distributions as cash, you've become the portfolio manager. You decide where that money goes based on current market conditions, valuations, and opportunities. This is active wealth management disguised as passive income investing. Let me show you how this works in practice. Last month, I received distributions from all my positions. Beta had run up significantly, so instead of automatically reinvesting those distributions back into beta, I deployed them to other relatively undervalued positions. This natural rebalancing mechanism is impossible with accumulating funds. Your money gets automatically reinvested into the same positions regardless of whether they are expensive or cheap. You have zero control, zero flexibility, zero strategic thinking. But the rebalancing advantage goes even deeper. During market volatility, different sectors and strategies perform differently. My crypto-exposed positions might be getting hammered, while my covered call strategies were collecting premiums. With massive income, I can redirect those flows strategically instead of being locked into automatic reinvestment. This flexibility becomes incredibly powerful during major market dislocations. This is why I call passive income investing controlled aggression. You are not just passively hoping for the best. You're actively managing your cash flows to optimize returns and manage risks. Now let's destroy another myth about accumulating funds: their supposed superiority during inflationary periods. Accumulating fund investors love to talk about how their shares will appreciate with inflation. But here's what they are missing. Inflation doesn't just affect your portfolio value, it affects your purchasing power in real time. With passive income portfolios, you have a built-in inflation hedge that accumulating funds simply cannot provide. Look at my positions. Many of these distribute monthly, and these distributions can grow over time as the underlying assets adapt to inflationary pressures. Take beta, for example. As Bitcoin potentially appreciates with inflation and monetary debasement, the distributions from these positions have the potential to grow, giving me increasing purchasing power over time. Maine, being exposed to private credit markets, often benefits from rising interest rates that typically accompany inflation. But here's the real kicker. With regular distributions, I can immediately reinvest into inflation-protected assets or adjust my strategy in real time. Accumulating fund investors are stuck waiting for their next rebalancing period, missing opportunities to protect against inflation as it happens. The income growth potential is something accumulating fund investors completely miss. When I started building this portfolio 3 years ago, my monthly distributions were much smaller. But as these positions have grown and been optimized, my income has increased dramatically. I'm not just preserving wealth, I'm actively growing my income generating capacity. This creates a compounding effect that's even more powerful than traditional accumulation. Instead of hoping for capital appreciations, I'm building an income machine that gets stronger every month. Each distribution gives me more ammunition to deploy strategically, creating an accelerating wealth building cycle. Now let's tackle the elephant in the room: taxes. Accumulating fund fanatics love to scream about tax efficiency, but they are missing the bigger picture. Yes, accumulating funds defer taxes until you sell, but here's what they don't tell you. You are essentially giving up control of your tax situation for the illusion of efficiency. With passive income portfolios, you have control. You can optimize your tax situation based on your current circumstances, not some theoretical future scenario. In many European countries, dividend income receives favorable treatment compared to capital gains, especially for lower-income retirees. Accumulating fund investors are completely at the mercy of market timing for their tax situation. When they finally start selling their retirement, they have zero control over taxes, market conditions, or their overall tax strategy. The tax argument for accumulating funds assumes perfect conditions, that you'll be in a lower tax bracket in a retirement, the tax laws won't change, and that you'll have perfect market timing when you start selling. In reality, passive income gives you the flexibility to optimize your taxes in real time based on actual conditions, not theoretical projections. Now I need to be crystal clear about something. Passive income investing isn't about eliminating risk, it's about managing risk more effectively. Yes, my portfolio has higher volatility than a simple accumulating world ETF. Beta can swing wildly, my leveraged positions can see dramatic moves, and my high-yield strategies come with their own complexities. But here's what risk-averse accumulating fund investors miss. They are also taking massive risk by having zero income generation. They are 100% dependent on market timing, forced selling, and perfect execution of their withdrawal strategy. My risk is spread across multiple income streams from different sectors, strategies, and asset classes. If one position blows up, my other income streams continue. If markets crash, I'm still collecting distributions while accumulating fund investors watch their portfolios bleed with no income to show for it. The key is position sizing and diversification across income sources. Notice how my portfolio balances high-yield positions with more stable income generators like main and GPQ. This creates multiple layers of income protection that accumulating strategies simply cannot provide. This isn't about being reckless. It's about building a robust income-generating system that can weather different market conditions while providing the flexibility to adapt and optimize over time. Look, I've just shown you something that most investors will never understand: why passive income portfolios are fundamentally superior to accumulating strategies. While others are trapped in the accumulating fund mindset, hoping and praying for capital appreciation, we are building income-generating machines that pay us regardless of market conditions. The evidence is overwhelming. Superior cash flow management, built-in rebalancing advantages, inflation protection through growing income, reduced market timing dependency, greater tax flexibility, psychological advantages of regular income. This isn't just a theory. These are the results from my actual six-figure portfolio generating over 25% annual yields. But here's the thing, this strategy requires a different mindset. You need to think like an income investor, not a capital appreciation gambler. You need to understand position sizing, risk management, and strategic allocation. So if you are ready to escape the accumulating fund trap and start building your own income empire, smash that subscribe button right now. Drop a comment below telling me about your current portfolio setup. Are you trapped in accumulating funds, or are you already building passive income streams? I want to hear from the psycho investor community. And remember, while everyone else is waiting for capital appreciation, we are getting paid today. This is how you build generational wealth while maintaining complete control over your financial destiny. Stay psycho, stay profitable.